Hello, everyone, and welcome to this latest episode of the Bull and the Bear podcast. I'm moneyandmarkets.com research analyst Matt Clark, and your host for the Bull and the Bear. Glad you're with us today. Just to get all the stuff cleared out of the way before we get started, if you're listening to us on podcasts, or if you'd like to listen to us on a podcast channel, you can listen to us on Apple Podcasts, Google Podcasts. We're also on Spotify, iHeartRadio, and at last count about 20 different podcast syndicators. So you can follow us that way. Go to your favorite podcast, syndicator of choice, and find the Bull and the Bear podcast. Just follow us, and you'll get updated every time we put out a new episode. Also, check out our YouTube channel. We video all of these, so all of our shining faces can be seen each and every week. You just go to youtube.com and type in Money and Markets, and you'll see our YouTube channel. Got a lot of stuff there. We've got our Week Ahead series. We've got a couple 101 series videos, the Bull and the Bears there. We're starting a few other things as well. So I encourage you to go and subscribe to our YouTube channel, and that way you get alerted to each time we put out a video. Also, if you want to leave us a comment, or you have a question, or you'd like us to, maybe there's a particular stock or something like that you'd like us to review in one of our videos, or perhaps on moneyandmarkets.com, you can email us, thebullandbear@moneyandmarkets.com. That's thebullandbear@moneyandmarkets.com. The email's in the show notes, but I'll also try to put that down at the bottom of the screen right here, so you can see what I'm talking about. So, and also don't forget to check out moneyandmarkets.com. All three of us on today's podcast, you'll see work from all of us, including myself, contributor Charles Sizemore, and our chief investment strategist Adam O'Dell. I'm going to bring those guys into the fold here in just a second. But first, let's get right to it today. In looking for sectors, I always take my cues from Adam, just because he does put out a leader and laggards board every week to several of his subscribers for both Green Zone Fortunes and his Cycle 9 Alerts subscription service. And I take my cues from there, just because I think it provides a nice balance and gives really good insight into something that we should be looking at. And this week was kind of an interesting leader for the S&P 500 sectors, and it's the industrial sector. And I thought that was interesting, considering how, if you look at the data, according to the Federal Reserve, industrial production in the U.S. has contracted at an annual rate of 43% in the second quarter. It's the largest quarterly decrease since World War II. Now, let's put that in perspective. In World War II, the U.S. was just booming in terms of industrial expansion, mainly for the war effort. And then after about 1946, 1947, that all tapered off because there was no need to build the massive amounts of military equipment and surplus that the country was building. So we saw a huge contraction in manufacturing. And it wasn't because of a coronavirus. It wasn't because of a downturn in the economy. In fact, it was leading into the booming 50s, where the economy was fantastic and wealth was spread out evenly and very nicely amongst Americans. So this time it's a little bit different. The contraction is due in large part to the coronavirus that we have that continues to kind of ravage across the globe, and as well as different economic factors, such as obviously GDP is down. We're looking at recessionary type economic figures. Factory output in the second quarter is down 47% at an annual rate. So basically, factories just aren't producing as much. But interestingly enough, if you look at the S&P Industrial Sector SPDR ETF, it has jumped more than 50% since reaching its low in March of 2020, along with all other stocks. So I think that's very interesting. So today, I want to talk about three different industrial companies. These are all companies that you know. These are all companies that you have heard of in some form or fashion, I'm sure. One of them might be a little bit an outlier, but I'm pretty sure you've heard of at least two of them. And then I want to talk about and get our take on each one of those. I will start right away with the first company. This is an aerospace and defense company. It provides advanced systems and services for commercial, military, government customers across the globe. It operates in four businesses. It's got its Collins Aerospace System, Pratt & Whitney. It's got intelligence and space, and missile and defense. And the big part of this company is that it recently merged with United Technology back in April of 2020 in a multi-billion-dollar deal. And it's big because United Technologies was a much bigger company than this one was. And now it is expanded rapidly. And the company I'm talking about is Raytheon Technologies. corporation. It trades under the New York Stock Exchange on the ticker RTX. And I picked this one just because I thought it was an interesting, it plays with government. It's in the aerospace sector or aerospace subsector. And I thought it was just an intriguing stock to look at. So I'll first toss it over to money markets contributor Charles Sizemore. And Charles, give me your take on Raytheon. What do you think about this a defense, aerospace and defense contractor?
Well, so this is going to be a tough market going forward for anything in aerospace. As we are well aware, the commercial airline sector is a disaster right now because of the coronavirus. I believe flight volumes, is that the right word? The number of flights being taken anyway, is even after recovering, it's at something like 15% of normal still, even after recovering. Maybe it's up to 20 by now, but it's not getting back to previous levels anytime soon. Even if you had a cure to the coronavirus tomorrow, it's not like the next day people are forming a queue to go to the airport. I mean, this will take a lot of time. And when it comes to budgeting new aircraft and whatnot, that's years. You know, that's not something that battleship doesn't get turned on a dime. Beyond that, there's the government angle. So we had a huge military spending bill a couple of years ago, and that's fine and good, but that's done now. There's not likely to be another big military spending bill anytime soon. Spending priorities for the government are likely to be more civilian in nature, rebuilding after coronavirus. There's not a lot of political demand for big military expansion right now. That could change, I suppose. But when I look at Raytheon, I see a good company for sure. I don't see a catalyst in the near term to send the shares higher. You know, to me, there's no compelling reason to tie up capital in this stock.
Okay, and now I'll bring in Money Markets Chief Investment Strategist Adam O'Dell. And Adam, what are your thoughts on Raytheon? Is this a company that's worth an investor's eye?
For me right now, Raytheon, both in the short term and the longer term, is a pass. Unless you think the Space Force is suddenly going to take over the Army and the Marines and the Air Force and the Navy, I really don't see an impetus for Raytheon to really get off its feet. This is a volatile stock. This is a stock that fell more than 50% during the Corona crash, and it hasn't really rebounded the way that most other stocks have. So I'm looking at the chart right now of Raytheon, and it's still 35% from its February highs. It's well below its 200-day moving average, meaning it's in a downtrend. One of my primary rules is that we only buy stocks that are in uptrends, because doing that not only increases your odds of success with a bullish trade, but it also decreases your risk of a drawdown. You have lower drawdowns if you buy stocks that are already trending higher. So Raytheon does not fit that bill as far as my kind of cycle 9 alert approach. It's not in an uptrend. It does not have market beating momentum. In fact, it has market lagging momentum. That's one point I want to make. Even though that the industrial sector, every week I do a leaders and laggards board, and I look at the 11 spider sector ETFs. Like XLI is the one for the industrial sector if you want to look it up. And even though that the industrial sector as a whole has the most market-beating momentum right now, and that's forward-looking, meaning over the next 2 to 3 months, is showing me a signal that thinks that that my system thinks that the industrial sector could outperform the market over the next 2 to 3 months. That sector as a whole is not in an uptrend yet. So you really want to be careful. I want to kind of caution listeners that you don't necessarily want to go into the whole entire industrial sector head first. You want to kind of pick spots within the industrial sector that look better favored. So right now, Raytheon is not in my favored list. As Charles mentioned, the airlines like American and Delta and Alaska Air, those rank at the very, very bottom of the industrial sector. When I basically run all of the top holdings of XLI through my 6-factor stock ranking system, which is part of my Green Zone Fortune service, they rank at the very, very bottom. So commercial airlines is definitely a no-go right now. As we'll talk about in a little bit, freight lines, like anything that moves packages and goods around the U.S., those are kind of at the top right now. So right now, you have to be kind of selective within the industrial sector, and Raytheon is definitely a pass for me right now.
And I agree. I like Raytheon as a company. I like, they have been a government contractor for years. They will continue to be a government contractor. I just don't know that I see government spending being what it has been. I think where Raytheon is going to make inroads is not necessarily in aerospace. I think it's going to be in missile defense systems. I think that's where their forte is going to wind up being. Commercially, I really just don't see them making any inroads at all. They've been very sparse in the commercial sector. I think they've been more geared towards government and military contracts. I don't see that international military spending is going to be a boon anytime soon. I don't see nations coming out of the coronavirus and deciding that now's a great time to spend more on military. So I think Raytheon is going to struggle. Their merger with United put them on good footing financially, but I think this where we're at in the market just is not giving Raytheon the ability to increase its sales, to increase its return on for investment assets and equity, which are all three negative at this point. Not negative in a huge way, but negative nonetheless. I think it's overvalued at this point, and I just don't see it as one to look at. Again, not a bad company. We're not saying any of these companies are good, bad, or otherwise. We're looking strictly at whether these are investment opportunities for you. And right now, Raytheon, great company, great American company, not one to invest in at this point for me either. So, moving on to our next our next company. This one is one that I would imagine just about everyone at least has either heard of or seen in their rearview mirror or something on the highway. And it's a company that manufactures basically massive engines, and these are diesel engines, natural gas engines. And they are worldwide. They're a global company. They have manufacturing facilities around the world. They're based obviously here in the U.S., but they market diesel, natural gas engines under their own brand as well as other customer brands. They are in heavy and medium duty trucks, buses, recreational vehicles, light duty automotive, even construction, mining, marine, rail engines, oil and gas, defense. I mean, they're in a very broad range of where they supply their engines. And the company that I'm talking about here is Cummins Incorporated. It trades on the New York Stock Exchange under CMI. So Cummins Incorporated. And Charles, I'll first ask you, when you look at Cummins and you look at, where your head's at as an investor, is Cummins worth your time to look at as an industrial sector stock to look at, to pick?
Yeah, sure. It's definitely worth your time to look at. It's funny. You would think with the economy in really a nasty recession, that something like an industrial truck engine company would not exactly be where you'd want to be. I mean, that would seem like a cyclical stock. But there's a much bigger picture here. Cummins does benefit from this transition to a greener economy, even though natural gas powered engines are still fossil fuel technology. It's still a lot cleaner than diesel. It's certainly a lot cleaner than unleaded gasoline. So Cummins is very much in the fight for a green market share. There are plenty of competitors in that space. Tesla's making trucks now. Nikola, which by the way, Nikola and Tesla are both named after the same person. Come on, guys, originality, please. Anyway, you do have a lot of competition in this space for greener trucking, but Cummins is an established player, and I actually really like this stock as a short-term pick and a longer-term play here on the greening of the economy. We don't really know who's going to win the presidential election, but if the polls are accurate and the betting markets are accurate, it looks like it could be a narrow win for Biden. If you do have a Democratic administration in office, there will be more pressure for companies to be greener. Cummins could be part of that solution. So I think there's a lot of pieces in place that bode really well for Cummins.
And I think it's interesting that a company that used to focus so heavily on diesel engines and on big rig engines is now in the same conversation as a company like Tesla. When you're talking about green green engines, if you will, or green power, I just think that's I think it shows a nice resilience on the part of a company like Cummins to to say we need to adapt, we need to change, and try to spread our wings a little bit, and not just be so narrowly focused. Adam O'Dell, what are your thoughts on Cummins?
I'm also favorable in Cummins. Like Charles hit on, you don't have to go from full diesel or unleaded to straight to electric. There is a kind of a transitional technology there in natural gas, which isn't the cleanest, but it's certainly cleaner than some of the older alternatives. So I think that rather than trying to bet the farm that electric vehicle, especially in the large trucking industry, is going to be is going to come online in the next year or two, which I doubt it will. I think that Cummins is a great kind of a steadier eddy play, an easier transition to a greener energy sector play. So I like it for that reason. I also like it for a reason that you touched on yourself, Matt. That fact that we're basically seeing these engines put into machinery across a number of different sectors. So home builders, they can go in cranes, they can go in the mining industry, they can go in the trucking industry. So it's not really, Cummins isn't tied to one particular narrow slice of one sector for success. So for me, that's good because it makes it more of a robust sales channel. So for me, I am high on Cummins. It's basically made a really strong recovery. The stock has. It's now trading a good bit above its February highs. So it rallied back and made gains even above its highs. It's now trading at all-time highs, just under $200 a share. As far as my rating system, my 6-factor rating system, Cummins rates very high overall. It gets an 88 score overall with strong scores in momentum, low volatility, value, and especially on quality. So the quality of Cummins book, its operational metrics are very strong, as are its growth metrics. So all in all, you're getting a great all-around stock, both long-term and short-term. The stock is in an uptrend. It's kind of stretched a little bit far from its 200-day moving average, and it's hitting new highs, like I said, just above 200. So I personally might wait just a bit, see if the stock can make a pullback to the $190, $180 share range, which is kind of where it broke out from above the February highs. Might get a cycle 9 type of signal around that area if we get a pullback. But either way, if you want to put some longer term money in Cummins, I think that's a great bet.
And that was really you hit on my real only concern with Cummins is the fact that it has broken through its February high, but is that a ceiling? Is it maybe going to test a high and then kind of pull back a little bit with overall stock market value being overvalued at this point?
I'll jump in there. I mean, I think that that's a huge psychological, and I love hearing it from you because I hear it from readers when they write in as well. I mean, buying a stock at its new highs feels scary, and it feels like the wrong thing to do. It feels like you're paying, the max price. You're not getting a good deal on it. But really, the momentum strategy is one of the strongest, most robust, most consistent strategies out there. And consistently, I mean, some strategies just buying new highs will help you beat the market. So, if you've done your due diligence, if you've rated the stock based on a number of different factors, and it's a quality stock for the long run, I'm not too worried about buying new highs. There is a very common chart pattern, which is called a breakout and retest, where you break out from a level and then the stock pulls back to that breakout level. And then that can be an even better entry point. You can get in at maybe 5 or 10% cheaper than you could if you bought as it was breaking out to new highs. But ultimately, it's a great stock. So, don't let yourself get scared out of buying a stock at new highs for sure.
Yeah, and that was really the only concern I had. Everything else across the board in terms of its numbers are solid. So I like Cummins as a long term play. I think it would be good short term as well. I'm more of a long term look ahead type of investor, but I think Cummins would fit the bill on either side. Moving on to our last stock in the industrial sector that we'll look at today. This is, and Adam alluded to this earlier, this is a motor carrier, or basically a freighter. They transport freight across the country, whether that is for commercial freight, whether that is for industrial freight. It could be moving you across the country. They do kind of all of that. It's regional, interregional, national services. They've got value-added services such as container drayage. We won't really get into that. Truckload brokerage, supply chain consulting, which, if you're a business that relies on third-party suppliers, this is a company that can help you try to navigate the waters of making sure you get those third-party products to you to build out that final component. It's got 9,296 tractors as of the end of 2019, 236 service, 42 maintenance centers. It was founded in 1934 in a small town in North Carolina, Thomasville. You probably know that as a furniture company because they're also based in Thomasville. But Thomasville, North Carolina is the home for Old Dominion Freight Line. It trades on NASDAQ under ODFL. And this is another one of those companies where if you've been on the highway, you've likely seen it in some form or fashion, whether it be spread across a trailer or on the side of a truck or something like that. You have likely seen Old Dominion somehow, some way. So I'll first throw it to Charles. Charles, Old Dominion is it's a leader when it comes to freight transport. But is it one that is it the one to look at in terms of if I'm looking at a freighter, if I'm looking at the industrial sector, is Old Dominion the one I should be paying more attention to?
I think it's certainly one worth looking at. It's funny. There's always name associations. Whenever I see Old Dominion, it makes me think of the bad guys from Star Trek, Deep Space Nine. I know I'm really showing what a nerd I am with that one, but those were the bad guys. So this is a trucking company named after the bad guys in Star Trek. I digress. I actually really like this. The specialty of this trucking company is, I believe the industry term is less than truckload.
Yes,
it's an
LTL.
Yeah, it's an odd turn of phrase there, but what that essentially means is they specialize in smaller truckloads. And so that's important for a couple reasons. I think we are seeing the end of this era of globalization. I think it was already frayed to begin with. And I think the coronavirus was just the death knell. Nobody really wants a really big global supply chain right now that's overly complex. Yeah, you can save a little money and fatten your margins a little bit, but at the risk of losing a major component part during the shutdown. We saw that throughout this coronavirus experience. Company after company has said, yeah, our diversified global supply chain, that sounded great before coronavirus. It really does look like a liability now going forward. We probably don't want to do this. We want to bring things closer to home. So smaller regional distribution networks should be beneficial for a trucker like Old Dominion. My only concern on Old Dominion at all is I do think the stock's a little bit on the pricey side. So I feel like we may be kind of chasing it higher. I'm also fully aware that right now valuation doesn't really seem to matter much. When the discount rate you used, how do you value stocks, right? Well, you apply a discount rate to the to future earnings, right? Well, when that discount rate's effectively at zero, the price of every asset becomes infinity because you're dividing by zero. And so we have a long way to go before we hit infinity, obviously. So I realize valuation metrics are almost meaningless in a market like this. Still a little bit concerned that the stock is a little bit pricey. I don't know how much that's going to matter over the next 6 to 12 months. So I would say this one would be a buy for me.
Okay, Adam O'Dell, your thoughts on Old Dominion?
This is a buy for me as well. Just to play off Charles, I will note that of my 6 factors that I rate a stock on, Old Dominion rates the second lowest on value with a score of 27 out of 100. It rates 19 on size, just meaning it's a somewhat larger company. But overall, I mean, I scanned all the holdings, all of the individual stock holdings in the SPDR Industrial Sector ETF, which is ticker symbol XLI, which was at the top of my leaders and laggards board this week. And of all the stocks, I mean, it's 30 or 40 stocks in that ETF. Old Dominion rates has the highest overall stock rating according to my system, up at 93 out of 100. So out of the entire universe of thousands of stocks, there's only about 7% of stocks that rate higher than Old Dominion across the board on momentum, size, volatility, value, quality, and growth. The six of the most important factors that drive long-term stock returns. I'll also note that JB Hunt Transport Services, ticker symbol JBHT, was rated number 2 within that sector with a score of 89. So you're definitely seeing this trend of freight and trucking being a very, an industry that's in vogue right now. Not just in vogue, but it's really showing that it can, withstand the storm and even survive and thrive during the coronavirus period. For instance, Old Dominion where most stocks were falling, 30, 40, 50, even 60% or more. Old Dominion only went down about 25% during the Corona crash in March. So it had about a 25% drawdown, and now it's trading in close to 25% above its February highs. So Old Dominion is another great example of kind of a breakout and a pullback. So it broke out above its February highs and made a bit of a pullback into mid-June, and now it's motored higher, making new highs again. So ultimately, I think short-term, long-term, trucking stocks are a good play across the board. Old Dominion and JB Hunt would certainly be at the top of my list.
I agree. I like Old Dominion. I like the way it looks. I like its figures. And Charles, to kind of speak to your globalization, I think there's a good way to illustrate that, and that is with automotive. And I use that only because of personal experience. And before 1994, 1995, if you wanted an import car, it had to be built overseas and brought to you. And it wasn't until 1994 that BMW built its massive plant in Spartanburg, South Carolina. And the reason why they did that was because they were trying to get product to market much quicker than trying to ship everything overseas. And now you're seeing this happen. You've seen it happen ever since. I mean, companies like BMW, Volvo, even Tesla. I mean, Tesla's got a plant in China. It's not because, obviously things are cheaper in China, but the thing is they want to get product to market faster. And I think that may speak to more of your pullback of globalization and how these supply chains may already be established. Now it's just kind of perfecting them and making them run smooth with a company like Old Dominion that would certainly do that. But yeah, I agree with you guys. I think Old Dominion is a buy long term. So to recap, Raytheon is probably a hands off at this point. But Cummins Inc. and Old Dominion are ones that as an investor you should definitely take a look at and do your homework on. And we've provided you with some insights, so maybe that will help guide you. So certainly appreciate the time that both Charles Sizemore and Money and Markets Chief Investment Strategist Adam O'Dell has provided us today. Thanks for coming on as you do each and every weekend, and certainly thank you for that. Before I go, just to remind you, if you maybe watching the video and you're thinking maybe you want to listen to this as a podcast, you can do so. You can listen to us on Apple Podcasts, Google Podcasts, Spotify, iHeartRadio, and a wealth of other different podcast channels out there. By all means, subscribe to those. Leave us a review. Leave us a comment if you'd like. If maybe you're going the other way and you're like, well, I listened to this, but maybe I'd like to see the video, you can do so. You can go to our YouTube channel, youtube.com, and just type in Money and Markets, and you'll see all of our podcasts there, as well as all the other videos that we produce on a weekly, daily basis. There's a lot there to digest, so you can see all of our old podcasts. Check that out. Also there you can subscribe, get alerted to anytime we put out a new video of any kind, and you can leave us a comment, review there as well. You can like our videos. If you have maybe a stock you'd like us to look at, maybe you'd like us to run it through Adam's 6-factor system, we would love to be able to do that for you. Just email us, thebullandbear@moneyandmarkets.com. And we would love to do that. If you have a pretty good topic you'd like us to address on one of our podcasts, we'd love to do that as well. Just email us. Again, that's thebullandbear@moneyandmarkets.com. That's going to about wrap it up for us for this edition of the Bull and the Bear podcast. So glad that you have taken the time to either download or watch the video or watch us through moneyandmarkets.com. Make sure you stay tuned. We've got more coming up next week, as we do each and every week. It doesn't really slow down for us at all. So for Charles Sizemore and Money Markets Chief Investment Strategist Adam O'Dell, I am your host, Matt Clark. And thank you for taking time to listen to this episode of The Bull and the Bear. And until next time, safe trading.